workflow. Imagine opening a trading app, placing a trade, watching the price move just a tiny bit, and suddenly your profit jumps or drops. You stare at the screen thinking, wait, what just happened? That tiny movement you just saw, that's the heartbeat of Forex trading. And if you don't understand it, you're basically trading blind. Today, I'm going to show you one of the most important concepts every trader must know: pips. What they are, why they matter, and exactly how to calculate them step by step, so you never feel confused again. And before we go deeper, if you want simple, beginner-friendly Forex lessons that actually make sense, make sure you like this video and subscribe to Forex Trading Rocket Signal B, because we break down complex trading concepts into clear, practical knowledge you can actually use in real trades. Okay, let's make this super simple. In Forex trading, currencies are always moving, up a little, down a little, sometimes fast, sometimes slow. But traders don't measure these movements in dollars or pounds directly. Instead, we measure them in something called pips. A pip is basically the standard unit that tells you how much a currency pair has moved in price. Think of it like a measuring tape. But for price movement, let me explain with an easy example. Imagine you are watching the Euro USD pair. If the price moves from 1.1000 to 1.1001, that tiny change is 1 pip. That's it, just one small step. If it moves from 1.100 to 1.1010, that's 10 pips. So pips are simply counting how far price travels. Now, you might be thinking, why not just say the price changed by 0.0010? Good question. Traders use pips because it makes communication faster, clearer, and standardized. Saying the market moved 50 pips is much easier and more practical than reading long decimal numbers all day. Here's something important beginners often miss. Most currency pairs are priced with 4 decimal places. In these pairs, 1 pip is usually the 4th decimal place. So if your USD goes from 1.1050 to 1.1051, that's 1 pip. If it moves to 1.1060, that's 10 pips. But wait, there's one special case: Japanese yen pairs. These pairs usually have only 2 decimal places. For example, USD JPY might move from 110.25 to 110.26. That change is 1 pip. So for yen pairs, the pip is the 2nd decimal place instead of the 4th. This is one of the most common beginner mistakes. So always remember that difference. Now let's talk about something you'll see on modern trading platforms. Sometimes you'll notice prices with 5 decimal places instead of 4. Like 1.10508 instead of 1.1050. That extra digit is called a pipette. It's basically 1/10 of a pip. Brokers use pipettes to show more precise pricing, but when traders talk about movement, we still focus mainly on full pips, serves. Now you know what a pip is. But here's the question that really matters. How much money is 1 pip worth? Because knowing price movement is useful, but knowing how much you gain or lose, that's what trading is really about. And this is where lot size comes in. In Forex, you don't just trade random amounts. Trades are measured in lots. A standard lot is 100,000 units of currency. A mini lot is 10,000 units. A micro lot is 1,000 units. For most major currency pairs, when you trade one standard lot, 1 pip is worth about $10. If you trade a mini lot, 1 pip is about $1. If you trade a micro lot, 1 pip is about 10 cents. So let's make this real. Suppose you buy your USD and the price moves up 20 pips. If you're trading one standard lot, you've just made about $200. If you were trading a mini lot, that same move gives you about $20. Same market move, different position size, totally different profit. This is why lot size controls your risk. Beginners who ignore this often lose money fast, not because their analysis was wrong, but because their position size was too big. Now let's walk through a full example together so this really clicks in your mind. Imagine you buy your USD at 1.10